I'd like to welcome Bill and Jack up to the podium, please. Bill Weisfeld, our past president, will be doing the introduction. And Bill is a former chair of our Federal Home Loan Bank of Seattle and currently is the chair of the advisory board of Harris Bank. And Bill, thanks very much for helping us have Jack join us today and give us his presentation. So, Bill, carry it away, please.
Well, thank you, Paul. It's my pleasure to welcome Jack Ablin back to our podium. Jack is the Chief Investment Officer for BMO Private Bank in the United States, and BMO stands for Bank of Montreal. Jack last spoke to us in 2010, and you'll probably notice that the market's gone up ever since. The Bank of Montreal, I thought you'd find this interesting. The Bank of Montreal was founded in 1817 and is the oldest financial institution in North America. It was previously known in Seattle, BMO was previously known in Seattle as Harris Bank, and besides Harris Bank, it also operates a division called MyCFO. We have 3 Seattle 4 Rotarians involved with BMO. We have our president, Peter Glidden, and we have 2 board members in Bill Sperling and Trish Bostrom, our banjo player. Our speaker today, Jack Ablin, is widely quoted in the Wall Street Journal, in Barron's. You've probably seen him on CNBC, and he's often quoted in these publications and gets a chance to appear often on TV. Jack is going to talk to us today about the economy, our debt situation, and our global competitiveness, all in about 25 minutes. And then we're going to make sure that we leave some time for questions and answers. So help me welcome Jack Ablin back to our podium. Jack?
Thanks, Bill. Thank you, everyone. I'm delighted to be back here. Let me just get this going again. I was actually struck by a comment that Paul made. He actually used ethics in Chicago in the same sentence, which was surprising to me. Anyway, so what I want to do is not waste a lot of time, but take you through how we look at the markets, how we look at the world through the lens of the United States. As a global macro investor, I tend to look at the world from 30,000 feet. This talk is actually a look from 100,000 feet to offer you a little perspective of where we've been, how we got here, and the steps that we need to take, and optimistically, I will say, to actually move to the forefront of global competitiveness. So with that, let's just start with where we were. If you recall, and probably not a surprise to anyone here, but if you look at these 3 lines, you see income, spending, and debt. And you'll notice that over the last, say, 30 years or so, that we've found that household spending at 4% growth has consistently outpaced our incomes. And we were able to do it by ratcheting up our debt. So we essentially borrowed money and spent it and used that to bolster our lifestyles. How did we get there? Because in 1980, if you remember, going into the late 70s, the Carter administration, and the malaise we had with stagflation and double-digit unemployment and double-digit inflation, that we ended up bringing in President Reagan, who deregulated, who then set the stage for outsourcing, unleash some productivity. And as a result of that, our economy grew, but at the same time, we left a whole class of people, generally wage earners, out in the cold, right, as we moved production and manufacturing to other countries. And we raised the stakes on what it took to become prosperous in the middle class. No longer could you have a union job or a high school diploma and a trade and assure yourself a place in the middle class. So recognizing this, instead of retraining everybody to meet the needs of this new world we're developing, a service-oriented world, right, one that looks very similar to what's emerging here in Seattle, we decided to take the cheaper route and extend credit to everybody. And that, taken from Greenspan on, every time we saw the economy slowing, we just lowered the borrowing rate and encouraged people to borrow more. So starting in roughly 1980, we got hooked on debt. And if you notice here, the red lines and the blue lines, what we find is that our annual growth rate was very, very closely tied to the amount of debt we took on, right? So we got hooked on this, enhancing the value of our economy on this debt formation. And that's fine until here, right? Until 2008, 2009, where we reached our capacity on the household level. We could no longer borrow anymore. We had to start shedding debt. And of course, the economy fell down, drew into recession, but more importantly, we had a financial crisis, right? Because we couldn't pay back our debts. So recognizing this, the federal government stepped in. And if you look at total debt, not just household debt, you can see we had this big ramp up. And then when we cut back in here, household debt, the federal government stepped in and increased their debt load so that the overall growth in debt at least stayed where it was. So we would be able to maintain our position on the debt. So now we have more capacity in the public sector, but the question is, how long can we run this particular scenario? How did the federal government do it? Largely with the help of the central bank, Federal Reserve. Here you can see this ramp up in the blue line, where at the end of 2008 and the beginning of 2009, the Federal Reserve increased their balance sheet from $900 billion to $2.5 trillion in 3 months, averting what could have been a financial calamity that would prompt a worldwide or certainly a nationwide depression. So I think the Fed did the right thing, and now they're growing their balance sheet to over $3 trillion. And as of this afternoon's meeting, they've also affirmed they're going to continue to grow their balance sheet at a rate of about $85 billion per month. Okay, thanks to this debt that's being created, supplementing this debt at the federal level. So that's where we are right now. And of course, we know that there is some capacity. Well, there are some positive outcomes related to that. One, most notably, is housing. By lowering interest rates, right? When the Fed started their program, the jumbo mortgage rate was 7.5%. Now the jumbo mortgage rate is below 4%. So for a borrower with a given budget for a particular payment, that means their buying power has gone up by about 35%, right? And at the same time, housing values have come down about 15%, at least on a national basis, creating now affordability here at a generational low. Best opportunity, I should say. And so that's setting the stage for nice little rebound in the housing market. At the same time, because housing values are up and stock values are up, consumer confidence is rising. And that's helping spending. So generally, consumer confidence and spending tend to work together. We have spending ratcheting up here and confidence increasing. They're likely to meet somewhere in the middle here, probably in the 0 to 2% range. But again, I'm very impressed with the amount of spending that's going on. Last month, we saw nearly a 10% year-over-year growth in auto sales and probably 6 to 8% year-over-year growth in furniture sales. Two categories that you would argue are very discretionary. Question is this a trend, or is this just replacing stuff damaged in Hurricane Sandy? We'll find out. I think there's probably part of it, but that's something we want to continue to pay attention to. Meanwhile, higher growth in spending has generated some profits, and hiring has picked up. In fact, now we're finding that there's actually tightening in the labor market, that 40% of executives surveyed found they're having difficult time finding qualified workers to meet their job openings. And so what we've done here is we have 3 bars. The first bar in yellow is just CPI. The next bar in red is corporate profit growth. And the blue bar is what we call wage index growth. And what we've done in our office is taken the unemployment rate multiplied it by the average work week in hours times the average hourly wage to try to come up with a sort of a proxy for paychecks. And what we noticed is over the last 4 quarters or so, not only have payroll growth exceeded inflation, so that's a good sign, but over the last 2 quarters, this payroll growth is starting to outpace profits, which suggests we are starting to see a tightening labor market and could potentially start crimping profits. Well, the point I want to make here is we have a tightening labor market, at least in some sectors, and I'm sure you're finding that here, and yet we have an unemployment rate of 8%, or nearly 8%, suggesting to me we have a structural mismatch between what the private sector is looking for and what the American workforce has to offer. Okay? I mean, think about how fast companies evolve. I still have a BlackBerry. Okay? Has anyone heard of that? Okay? Yeah. And you know what? And they're still around, but that's how fast this business is evolving, and the skill set of our workforce has to keep pace with it, and currently it's not. So education in a service-based economy where 90% of the jobs in this country are service jobs is critical. Now I use degrees here, diplomas as a proxy. Clearly it could also be training or other specific skills, but the point is if we want to bring the natural rate of unemployment down, printing money is one way to do it, but it's going to come at a cost of inflation. The natural rate of unemployment, in order for that to come down, we have to improve the mix, right? The diploma mix, so to speak, or the skill mix of our workforce. And by doing that, we can bring our workforce back into alignment with our private sector. Meanwhile, we're hearing now new immigration laws where we're trying to import engineers, right, from other countries because we don't have the capability yet of minting enough of these people on our own. So here's the problem. If you use math scores, I have a math degree, so I like to use math scores as a proxy for skills. This isn't a bias sample. But if you use the math SAT score, it's called PISA, but it's very similar to an SAT. And you can see here the average math SAT score, PISA score is roughly 480 for American kids age 15. And the OECD average is nearly 500. But look at this. We're competing with Shanghai, China, Singapore, where those kids are scoring 600s on these same tests. And so it stands to reason that eventually, as our global supply chain kind of meshes even further, and skills are going to be used interchangeably worldwide, that eventually these kids are going to be doing the same kinds of things that our kids hope to do, which is fine, but here's the problem. This, to me, I want you to walk away with this chart in your mind, because this, to me, is the scariest chart we have in my deck. So per capita GDP in the U.S. right now is about $38,000. Per capita GDP in China is about $2,600. Now, let me make a few adjustments. One, I want to make adjustment for urban China, and I want to make an adjustment for the yuan. Maybe the yuan is a little bit undervalued fundamentally relative to the U.S. dollar. So if you make those two adjustments and you squint a little bit, you'll get it to probably about $10,000 per capita in China. Okay? Now, those kids are scoring 600 on their math SAT scores, and we're scoring 480. So can you buy the argument that over time, as they continue to do things that our kids are trying to do, and they have virtually equal opportunity to do it, that over time these lines are going to have to cross? You agree with that? Okay, here's the problem. In a debt-based society, if that number crosses at, say, 30,000 or 28,000, we're going to default on all our debt. So this number has to cross at 50,000. This line, that blue line, has to keep rising, or we're going to have debt problems. Okay? And we have to do it in a way where we're going to do it in an organic way using education, but we're going to also do it in an artificial way. What do we mean by that? Well, let me start with our manufacturing advantage first. Good news is we've reduced the value of our currency, roughly 30% or so over the last 10 years, 12 years relative to the euro and many other of our trading partners' currencies. And as a result of that now, we actually have the best place to do manufacturing business in the developed world. So when you hear that companies like Airbus, a French company owned by a consortium of European countries, announce plans to open a plant in Alabama, they're crying uncle. Okay, their currency is too expensive. And now Japan is targeting a 2% inflation rate. Their currency, the yen, just dropped 30% against the euro in the last 90 days. Okay, they're going to have to start getting onto this currency bandwagon. But meanwhile, as I said, we need to still improve our skills near term. Where are the jobs going? They're going to right-to-work states. Okay, so if you look at the growth in manufacturing jobs over the last 4 years, these aren't cumulative, these are just each individual years. You can see in each year of the last 4 years, right-to-work states have outpaced forced union states on the manufacturing front, both on the downside and the upside. So not a surprise that Michigan has shifted to right-to-work, because Indiana's just shifted to right-to-work. And by the way, Indiana's getting a BASF plant from Germany. Okay? There's one other secret ingredient behind this trend, and that's this, natural gas. Thanks to exploration and new innovation in production, we now have an abundant supply of natural gas. And on a BTU, right now our BTU is about $3.50, $3.55. And so if you equate that on a BTU equivalent basis, MCF, about $3.50. On a BTU equivalent basis, that's like pumping oil or using oil at about $22 a barrel. So there's a huge opportunity to move from diesel transportation to natural gas transportation, diesel transportation to liquid natural gas transportation. And from what I understand, works out to be about 25 to 50 cents a gallon. Huge opportunity there, and that's already underway. But the other advantage we have is that natural gas, without a pipeline and huge commitments in liquid natural gas facilities, doesn't transport around the world very easily. And so that $3.50 natural gas that we're buying, costs $9 in Europe and costs $15 in Japan. Another reason why we're seeing this huge resurgence, or at least this trend toward manufacturing back here at home. Great opportunity. But the fact is, this is still a near-term phenomenon, and we have to solve long-term, because clearly they're going to understand if they can start lowering the values of their currencies, then they can try to swing the pendulum back in their direction. We also have a fiscal imbalance, right? We're collecting taxes at roughly 15% of GDP, and we're spending 24% of GDP, creating this $1.1 to $1.3 trillion annual deficit. And the Congressional Budget Office says, it'll narrow. We have to figure out where we want to balance this budget. Are we going to do it at 18%, which is kind of a high number, long-term median, I should say, or 20.5%, which is a Simpson-Bowles argument, or although we've never really been consistently at that level in the past ever, or somewhere else. And that's the big concern of Washington right now. I argue, who cares? Because whether we're at 15, 18, 20, all we're doing is forestalling the time we hit this cliff, and that's the healthcare Medicare cliff. And without trimming this one, it's really just a matter of time. Is it 2040, is it 2047, or is it 2050 that we get overwhelmed by healthcare costs and this huge surge in retirements? So that's kind of the debate going on. So I've just laid out the problems. Okay, how do we fix it? Okay, how are we going to challenge this? Well, step one, we have to, and the Fed has already embarked on this. We're going to create this environment of financial repression. We want to run inflation up here and interest rates down here, and then use that to grow risky asset values like housing, like equities, like other things, and allow us to pay back our debts with cheaper dollars. And guess what? It's worked. It's worked in the past. Between 1945 and 1955, we were able to reduce our country's debt load from 125% of debt to GDP, which is higher than it is now, down to about 55% in one factor by running inflation up in here and interest rates down here, and slowly pay back these debts with cheaper dollars. That's step one. And already, we're in an environment where inflation is higher than interest rates, right? We've got a Fed out here targeting 2.5% inflation, and we've got a 2% 10-year Treasury, and of course we have an overnight rate at effectively zero. And so this gap should continue to widen, and the Fed is going to continue to buy treasuries and hold interest rates low for as long as they can. And so, yes, we're going to see this uptrend in inflation. What does that mean if you own risky assets and you're in an industry that has pricing power? Great. If you're a retiree who is relying on the value of your portfolio to generate income to meet your spending needs, then you got to take a serious look at what you're doing, because you're on a path to a lower standard of living if you're not careful. The next step in the evolution of solving our issue is to free up corporate America. Unfortunately, I'm not getting a lot of feedback from Washington right now, at least across the board. But I will tell you that, as you all know, as business people, the U.S. has the highest corporate tax rate in the world. And that may not mean much to Microsoft. It may not mean much to other global players, but it certainly means a lot to small business people. And unfortunately, or like it or not, virtually all of the new job growth that we enjoy in this country comes from companies of 20 employees or fewer. And these are companies paying high tax rates. If it's not corporate, then it's personal, and they're very high either way. What I suggest we do is separate corporate taxes, personal taxes, and I argue let's make the corporate tax rate zero. Now, I know there were a couple of attorneys and accountants in the room, and I recognize that we spend as a nation $200 billion a year avoiding taxes, and we'll have to figure out some other way to spend that money. But you can see over time, corporate tax collections as a percentage of GDP has been on this steady decline for a number of reasons. One, as I said, companies do business in other countries. They're going to funnel their profits to other countries. When you funnel your profits to other countries, you're going to funnel your retained earnings to other countries. And when you funnel your retained earnings to other countries, you're going to funnel your cash to other countries. And so when it comes time to make the investment decision, the hiring decision, or the expansion decision, you're going to do it where your cash is. And so when Microsoft bought Skype a couple of years ago for $8.5 billion of cash, Skype was a European company, and Microsoft happened to have $8.5 billion of cash stranded in Europe. So it made total sense. If Skype were an American company, they may have bought them, they may not have bought them, who knows. So to have someone like Jeff Immelt on President Obama's Jobs Committee, to me, was a complete indictment of the process, because under Jeff Immelt, more jobs are created in other countries, fewer jobs here in the U.S. He's doing exactly what Congress is encouraging him to do. Push your business into other countries where the tax rates are lower. So let's make the tax rate zero. And by the way, 94% of all taxes collected in this country are personal taxes anyway. Let's take the corporate tax rate and make it zero. If you look at corporate taxes, or I should say the last 10-year growth as a function of corporate tax rate, you can see there is this upward bias. Okay, so think about it. If you're a small business person, your small business now is your IRA. And when it's an IRA, you're going to want to keep your wealth in that business. And if you want to, you're going to want to grow that business. And if you want to grow that business, that means you're going to have to continue to expand and hire. Okay? And the minute you take money out or any benefit out of that business, whether to pay yourself, your employees, or anybody else, that's when it gets hit with the personal income tax. But now it undercuts the argument that the Republicans have that say if you tax the wealthy, you're taxing the business owner, the job creators. Not anymore. That's on the corporate side. And so I think it's certainly worth investigating. So that's the intermediate term solution. Longer term, is, as I intimated before, is college, it's training, it's getting our workforce in line with the private sector. And I do think an intermediate step would be some kind of an immigration reform that allows us to supplement our skills with professionals from other countries and welcome them here until we can get to a point where we can mint our own talent. But here's the problem. For as expensive as medical costs are, tuition is just out of this world, far outpacing household income. And now creating an exclusionary policy where if a college diploma is the ticket to the middle class, it's just unattainable for more and more Americans these days. You know, hardworking. So consider this. 85% of 25-year-olds in this country have a high school diploma, but only 28% have a college degree or more. Okay? That to me is a gap that's just unacceptable. But I can certainly understand why it's there and why we have $1 trillion of school loan debt. Now, when it comes to our graduation rate, this is an associate's degree, but you can see among the 20 countries, we're ranked pretty low. That other countries that we compete with are doing a better job of getting their kids through at least an associate's degree level or more. Now, you'll notice Germany's absent from this list. Okay, Germany doesn't obsess with college diplomas, and in many respects, I don't either. I'm just using it as a proxy for skills. But Germany has done a great job aligning their schools with the needs of their businesses to provide them with talent 3, 4, 5 years out. And a lot of these curriculums are actually designed by the companies they do business with. But here's the secret. I think we're about to witness an explosion in education that's going to blow the doors off of college tuition. And I'm sure, have most of you heard of what a MOOC is? Massively open online course? That you can now, anybody can go on the internet and take classes from some of the most prestigious universities in the country for free. And so already we see this distribution of knowledge that will start to permeate this college level and even come down to the high school level. But up till now, it's just been this loose flow of information that nothing's really tied together. You could take all the online classes you want and become very knowledgeable, but how does that look on a resume, right? Who's going to recognize this and hire you for the classwork that you took for some MIT program last semester? Until now. This last week, I learned that the University of Wisconsin is announcing a program starting in the fall for at least a handful of degrees that are now just based on knowledge. They more or less say if you sign up for these classes, if you sign up for our program, we'll give you a curriculum, but we'll just give you a series of assessment tests. And if you pass them, we will award you with a degree or a designation, depending on what it is the subject is. So now you have something that can take all of this information, tie it together, and put it on your resume. So I think that this, to me, is the beginning of an explosion that between, yes, some inflation, yes, easing the corporate tax burden, and then this explosion in education will actually take the U.S. to a leadership position globally And I'm very, very, really enthusiastic about where we're going with this. So thank you very much. I appreciate the time. What I want to do now is spend a little bit of time. Oh, just the last point on this, just to show that there are all the currencies relative to the dollar. So they are going to come down, but I think that all in all, we're very well positioned relative to the rest of the world. So thank you very much.
Thank you, Jack. When we spent a couple minutes with Jack, there's so many topics to cover, so we wanted to make sure to save some time for questions and answers for Jack. So we have time for several. So Laura, you want to start, Laura? Thank you, Jack.
Thank you.
Thank you very much. You mentioned the MOOCs. Can you tell me the business model? Coursera is the other big one Stanford and the Ivies put together. What is the business model for making money out of this venture?
I don't think there is, actually. Most of the universities providing this information are doing it pretty much free of charge, and there really is no, I don't think there is a profit motive. So, for example, even the Khan Academy, which has a whole series of math lessons for high school students, again, I think bankrolled by Bill Gates and just out there. And so, yeah, this works for the types of things that I study. Math, for example, there have probably been no innovations in math for the last 50 years anyway, since that four-color theorem. But, that's pretty much it. So, if you can start teaching concepts, and I believe, in my view I think math, again, is not that it's that complicated of a subject. I think it's just taught very poorly. And so, if we can get the best teachers, get them on these platforms, then allow the local teachers to even supplement that, I think we're going to find we're going to have a lot more, math and engineering kids, coming through the system.
Thank you for your comments. You mentioned the unemployment rate at 8%, but we know there's a lot of people that have left the workforce. Can you talk about what the real unemployment rate is and how that really is affecting our economy?
Sure. I think if you look at the household survey, you look at labor participation rates, you're right. I would say I don't remember the exact number, but I'm going to say the effective unemployment rate, or if you throw underemployment in with it, we're looking at rates closer to probably double that. And again, it's really just a function of keeping your skills in line with the workforce. Let me give you an example. If I were trained as an elevator operator and I went around, Chicago operating elevators, and slowly all the elevator companies went to automatic elevators, if I didn't retrain, I would find my job opportunities start to really narrow, and then I would probably have to compete for fewer jobs with more elevator operators, and my wage would not keep pace with inflation. So if you look at skills like construction, mining, the other sort of the skill sets, relative to inflation, I know, for example, mining, I think construction jobs are down 22% relative to inflation over the last 20 some odd years. So it is sort of this understanding, and we're not there yet. Yes?
On your first slide, I think it was your first slide, you had consumption and you had debt, but it seemed like cut off a couple years ago. Have you updated that?
Yeah, so that was, I think it's government data that looks on an annual basis. I think I have it through 2011. I don't have a 12 number yet, but no, it's still pretty much, I can update it, and those were the freshest numbers I have. Yeah.
One more question.
Anything else?
If every country determines it's in their best interest to devalue their currencies, where does that take us? Does the United States win that race? And what's the result?
Yeah, that's a great question, and something I probably lose a lot of sleep over at night. I don't know what the answer is. I do know, like I said, we're starting this race. And in fact, one of the online classes I took was a game theory class. I didn't take economics in college. It was taught very poorly at my college, so I just dropped it. And one of the things I would have liked to have taken if I had gone through just the entry level would have been game theory. So I took game theory online through MIT or something. And unfortunately, it's one of those things where stable state is everyone starts lowering the value of their currency because they realize if they don't, then they're going to be odd man out. So what's happening, the irony with Europe is, look, they've taken all of these steps to assuage the bond market that they're not going to, they're going to maintain this currency. And all the while, ironically, it's helped build the value of the euro. And all of that convincing is now undermining their economy. So in a world where, think about it this way, okay, with the euro, the euro or the yen relative to the euro is now 30% cheaper in 90 days. So when it comes to buy a Toyota versus a Mercedes or a Lexus versus Mercedes, who do you think has the advantage? That's the problem. And I agree. I don't know what the outcome is yet. I'm going to have to sharpen a pencil and think about it. But I do believe that we're setting the stage for currency wars, and we have to, we just have to be careful about what the outcome is. But thank you very much for taking the time.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health.